Welcome to this explainer. I am so glad you're here today because we're going to take something that honestly might look like a totally dense chapter from an accounting textbook and we're going to transform it. We're turning Chapter 7, Bills of Exchange, into a crystal clear guide on what is essentially the lifeblood of business credit. I mean, if you've ever wondered how massive amounts of goods change hands without any immediate cash, well, you're in the exact right place. Let's get right into it.
Okay, so let's dive into this. Picture a super common business scenario, right? A seller wants to move some inventory, and a buyer really wants to purchase it. But the catch? The buyer just doesn't have the cash today. They need credit. Now, the seller is totally willing to give them time, but how do they safely trade without getting burned? A simple handshake? Yeah, that's not going to cut it in a courtroom. What they really need is a rock-solid, legally binding business IOU. And that is exactly where the bill of exchange enters the chat.
So here is our roadmap for today. We're going to cover 1. The anatomy of a bill. 2. The key players. 3. Lifespan and mechanics. 4. 4 paths to payment. 5. Honor, dishonor, and consequences. And finally, number 6. Advanced bill scenarios. It's a highly logical journey from the birth of a bill to its ultimate financial fate.
All right, starting with Part 1, Anatomy of a Bill, the Legal Superpower IOU.
So we need to frame this document not just as, a casual piece of paper, but as a highly formal financial instrument equipped with some serious legal superpowers. Under Section 5 of the Negotiable Instruments Act of 1881, a bill of exchange has a very strict legal definition. The absolutely crucial point to remember is this: it must be an unconditional order. It's in writing, it's properly stamped, dated, and signed by the maker, but I really want you to notice that word order. This isn't a polite request. It is a direct command to pay a certain sum of money to a specific person or to the bearer of the instrument. Seriously, no ifs, ands, or buts allowed.
Now, what's really interesting here is how this physical document actually works in practice. When the seller first writes this out, it's just called a draft. It literally holds zero legal weight at that point. It only transforms into a legally binding bill of exchange once the buyer, who we call the drawee, physically signs their name along with the date right across the face of the document directly under the word accepted. That single signature, that is exactly what activates the bill.
Moving on to Part 2, the key players. Who's who in the transaction?
Basically, there are 3 primary roles in this whole transaction. First up, the drawer. This is the creditor, the seller who draws up the bill because, well, they're owed money. Second is the drawee. This is the debtor, the buyer, who actually accepts the bill and becomes legally bound to pay it. And finally, we have the payee, the person who actually receives the cash at the end of the day. Now, here's a kind of fun twist. While these are technically 3 distinct roles, in most everyday transactions, the drawer and the payee are actually the exact same person. The seller writes the bill, and the seller gets paid. Simple as that.
Next up, Part 3, Lifespan and Mechanics, the ticking clock.
The moment that bill is signed, a ticking clock officially begins. But before we start counting down those days, we have to look at how the drawee actually accepted the bill. Usually, we see what's called a general acceptance. That means the drawee accepts the terms exactly as the drawer wrote them, no strings attached. But sometimes, a drawee might issue a qualified acceptance. This means they're kind of changing the rules of the game. They might accept it, sure, but only agree to pay a partial amount, or demand to pay it only at a specific location, or even ask for a change in the time frame.
Okay, so assuming we have an accepted bill, we need to calculate the maturity date. That's the exact day the money is actually due. We start with the date it was drawn or accepted, and we add the agreed upon term, let's say 2 months. Then, by law, we have to add exactly 3 days of grace. This just gives the drawee a tiny bit of breathing room. But here is a wild and totally vital rule you've got to know. If the calculated due date happens to land on a known public holiday, like January 26th, the bill must be paid the working day before. But if an unforeseen emergency holiday gets declared right on the due date, the payment is pushed to the working day after. Crazy, right?
All right, Part 4, 4 paths to payment, the drawer's choices.
I want you to imagine you're the drawer for a second. You're holding this freshly accepted, legally binding document. What do you do while you're just waiting around for maturity? Well, the bill can go on one of 4 different adventures. Path 1, you just retain it. Keep it safe in your desk drawer until the due date rolls around. Path 2, maybe you need cash right now. You can actually discount it with your bank, which essentially means you're selling the bill to the bank early for just slightly less than its full value. Path 3, let's say you owe someone else money, so you endorse the bill, passing it along to your own creditor, basically like it's currency. Or path 4, you simply send it over to your bank for safe collection, letting them handle all the annoying paperwork on the due date.
Which brings us to Part 5, Honor, Dishonor, and Consequences.
So, we've finally reached the absolute climax of our bill's life cycle. Payday. When that legally calculated due date arrives, only one of two absolute outcomes can happen. Either the drawee comes through with the cash, which is called honoring the bill. This is great. It discharges everyone's liability. Transaction successful. Or the drawee fails to pay. They just don't have the funds. This is known as dishonoring the bill. And honestly, this is where the accounting side of things gets incredibly interesting.
And this brilliantly illustrates a universal golden rule in accounting. Just consider the journal entries for a dishonored bill. No matter which of those four paths the bill took earlier, whether you retained it, discounted it, endorsed it, or sent it for collection, if that bill bounces, the drawee's account is always debited in the drawer's books. You literally must immediately reinstate the drawee as your debtor, because at the end of the day, they still owe you that money.
Now, when a bill is dishonored, there is also a very real legal penalty involved, called noting charges. To actually prove in a court of law that the bill bounced, the current holder has to take it to a government official called a notary public, who officially records the dishonor for a small fee. Now, whoever is holding the bill at that exact moment, maybe the bank, maybe an endorsee, they pay the notary up front, out of pocket. But legally, the ultimate financial burden of those noting charges always falls squarely on the drawee who failed to pay. It literally just gets added straight to their debt.
Let's head into our final section, Part 6, Advanced Bill Scenarios.
So, we've covered the standard life cycle, but let's be real. Business is rarely perfectly standard. So let's explore what happens when timelines go completely off the rails. Let's contrast two completely opposite situations. First up, renewal. Imagine a struggling drawee realizes there is absolutely no way they can pay the upcoming bill. So, they beg the drawer for an extension. This requires legally canceling the old bill and drafting a brand new one from scratch. But the drawer is definitely going to charge interest for that extra time. On the flip side, we have retiring a bill. This is when a flush, cash-rich drawee decides to pay the bill before the actual due date. And as a reward for that early payment, the drawer grants them a discount, which is known in the accounting world as a rebate.
Finally, we do have to look at the worst-case scenario, insolvency. This is when the drawee goes bankrupt. Their liabilities completely exceed their assets, and they simply cannot pay their debts. The very moment insolvency is declared, the bill is automatically dishonored, and whatever fraction of the bill cannot be recovered from the drawee's remaining estate, well, that is permanently written off by the drawer as an unrecoverable bad debt. It's a tough situation, for sure.
We've seen just how incredibly strict the laws and accounting rules are for these physical, stamped, handwritten documents. But the source material leaves us with a really fascinating point to chew on. Modern business is fully transitioning into computerized accounting software. It really begs the question, as our ledgers move entirely to the cloud, how will the highly formal, paper-based tradition of the bill of exchange evolve to keep up with instantaneous digital commerce? It is definitely something to think about. Thank you so much for joining me on this explainer, and keep learning.